Hi, this is Jyoti Prakash from PRPH Associates with a weekly update on markets. Last week, markets rose across the globe, but S&P 500 rising by only 1.5% for the week was a bit of a disappointment after a 5.7% rally in the first couple of days. India's absolute positive return is a bit surprising under the circumstances of declining rupee and rising bond yields. The global equity setup, if anything, has deteriorated with OPEC announcing production cuts, which will provoke retaliatory actions maybe from US and Europe. Now, if quantitative easing compelled investors to be short volatility and long risk, quantitative tightening should encourage long volatility and short risk. With the risks of recession rising, the analyst estimates of earnings could be reduced in the coming quarters. Quantitative tightening has now gaining in pace. The last 3 weeks, the US balance sheet has shrunk by $74 billion. So short liquidity will make it very difficult for risky assets to rally. The beginning of last week, there was a lot of fret around Credit Suisse, only to realize that we are making a mountain of a mole because the size of that bank is smaller than the sixth largest bank of India. This is the global picture and how and where India is placed. So the positives about India is that it's just 5% away from Germany in terms of free float market cap. The highest EPS growth in calendar year 23 and 24, best performing markets in 2022, both in local currency and in dollars. But what are the negatives? The negatives is that it's the most highly valued, overvalued market with highest P multiple both in for both based on 22 and 23 earnings. Highest price to book value, lowest dividend yield, and highest CAPE ratio. Why has India been doing well? These are the data releases this week. There are many other positives as well. The health of corporate sector has been on the mend, and we all know that financials carry the highest weightage in India. So healthy balance sheets of corporate bode well for equities. When we judge from the ratio of upgrades to downgrades by rating agencies. As a result of outperformance, India's share in the world market cap is at a new high of 3.6%. I think for the first time in decades, India's share of GDP and market cap are in alignment. The CMA's data highlights a big positive for India with the unemployment rate dropping to lowest levels in 4 years for the month of September. There will be few negatives as well. Here we are seeing that the household savings as a percent of GDP is at 10.8%, lowest in 5 years. This is RBI data. This is a lovely editorial written by T.N. Ninan, the editor of Business Standard. So one can look at, read or whatever is written to kind of sum it up. He is talking about, loss in momentum for Indian markets and that the probability of GDP growth, falling to 4% during second half of FY23 cannot be ruled out, and 4% is what we were growing before the pandemic. There has been cut to India's growth estimates by a lot of economists and institutions, and World Bank has been the latest, and it has surprised people for their sharp 1% cut in the GDP growth rate for FY23 for India from 7.5% to 6.5%. Coming to the bond market, the bond yields are again, getting back to recent highs. The volatility of the bond market in US is plus at plus the standard deviation level, and the bond yields are fluctuating based on markets perceptions about US Fed pivot. There's a Bloomberg article on bonds inclusion, India bonds inclusion in global indices. What we realize is that the problem is not so much about the Euroclear listing, because both Chinese and Indonesian bonds don't qualify on that ground. I think what is holding investors back is the high taxation of India, with short-term taxes going up to 30%, and there's a 5% withholding tax. So global investors are anyways waiting till we have the peak Fed rates and probably hoping that India does something about reducing the level of taxes. This is an acknowledgement that the Fed has got it wrong. Initially, they thought inflation was transitory. So what we are saying is the most front-loaded rate hikes in the recent history, and this is likely to continue. The probability of a 75 basis point rate hike during the month of November for the US has now gone up to nearly 80%. There's a synchronized way of raising rates across the world and on a net basis, because there are some countries who are cutting rates, like China and Turkey. So on a net basis, nearly 20 countries are raising rates. This is increasing the probability of a synchronized recession. Now, initially, because of the intervention by Bank of England, one did see the correction in the yields in the United Kingdoms, but the second going back, and the market doesn't seem to be believing this story, and therefore the mortgage rates keep continuing to go higher there, in spite of the promises of better fiscal management and better monetary authorities intervention. See, now we are beginning to see policy divergence across the world. Different countries are responding differently because of underlying fundamental reasons. For example, the housing crisis, if you look at the chart on the right, it's a bigger problem in countries like New Zealand, Sweden, and Australia. And therefore, any slowdown in the housing sector is prompting them to go in for a lesser rate hike, like we saw the last time. Bank of Australia, Reserve Bank of Australia, only raising it by 25 basis points. Similarly, we are seeing divergence in UK, Canada, and Turkey. So this basically means it has implications for the currency and the bond yields in these countries, and therefore the relative supremacy of the US dollar is likely to continue. Now, during the pandemic, for the first time in many years, we saw equities deliver negative returns on a 5-year basis. And look at this chart. What it's trying to tell us is that on a 5-year basis, the US bond market has given negative returns. And this is, all of us know, economics 101, that bond prices decline when yields go high. REITs and InvITs haven't done so well last week, but I think the permission for them to issue commercial papers will bode well, as it should reduce their cost of funds. Crude oil, the news about 2 million barrels per day cut is not a good news from OPEC Plus. It increases the risk of inflation and recession. And the fact that the Saudi is in collaboration with Russia is something which is not a happy outcome. And this is after a fortnight of Biden visiting Saudi Arabia. Now, the production cut won't be as much as 2 million barrels. It will probably be around 1.1, 1.2 million barrels. But any retaliatory action from US about freezing assets of countries like Saudi Arabia, although that's not our base case, will create a lot of disturbance in the market. There's been discussion about India's 100 billion reserve drop. What RBI said is that $55 billion out of that is towards mark-to-market losses on the investments made by RBI, and $45 billion is what the RBI has intervened in the forex markets to try and reduce volatility in the dollar market. With the recent underperformance of Indian rupee, now we are there. That outperformance is getting diminished. We are about now 10% down vis-a-vis the dollar since the beginning of the year. There are a couple of countries which have done better than the US dollar. Japan, again, trying to protect its yield curve, and therefore the currency is depreciating at a big pace. And in spite of intervening by $54 billion in September, it is not able to protect the currency. So trying to spend dollars to save the currency is not a great thing to do. This is a comparative chart in terms of import cover for many countries. Now, interesting is that India's import cover is still very respectable. According to this chart, it's at 10, but maybe currently it's closer to 8. But look at countries like Austria and Belgium, which have a 1 month kind of import cover. Of course, the exporters have a very large import cover, like Saudi Arabia, at 25 months of imports. So this is another adverse effect outcome of trying to keep your currency strong. And what has happened is the last 12 months, trailing 12 months, India's imports from China has been $100 billion, and with our exports of only $13 billion to China, we are looking at a trade deficit of $87 billion. So I think this is not going to go down well, and therefore we are probably going to see the rupee giving up some of the gains, going forward. Asset allocation is the play in, and over the years, because of the passive investing gaining in pace, what we are saying is that the ETF providers today are the three top ETF providers today are the biggest holders in S&P 500. Data releases this week, the ones of importance are that exports have fallen by 3.5% and imports are up 5.4% in September. Of course, services exports doing fairly well, up 20.3% for the month of August. Read first estimates of retail inflation for September. That's not a good number, 7.3% for Barclays, although the October number will be on the lower side because of a positive base effect. The forex reserves have fallen by $4.8 billion, and the PMIs for India have somewhat fallen, and the World Bank has cut India estimates to 6.5%. So thanks for watching. Have a nice week ahead, and see you again next week.